Hey, it's Alex. In this video, I'm going to show you how choosing the wrong inventory method is silently draining tens of thousands of dollars from your business every single year, and more importantly, how to fix it. By the end of this video, you'll understand exactly which inventory method maximizes your cash flow, reduces your tax burden, and positions your business for sustainable growth, whether you're doing 200,000 or 20 million in revenue. What this means for your business is that you'll stop leaving money on the table. You'll make one strategic decision about how you account for inventory that compounds into massive savings over time. And you'll finally understand why some businesses in your industry seem to have better margins than you do. So here's what most business owners don't realize. Your inventory valuation method isn't just an accounting preference. It's a strategic lever that directly impacts three critical areas of your business. The first is your tax bill. The method you choose determines your reported profit, which determines how much you pay in taxes. Get this wrong and you're writing checks to the government that you could be reinvesting into growth. The second is your cash flow. Some methods inflate your profits on paper while your bank account tells a completely different story. You may look profitable, but you're scrambling to make payroll. Third is your ability to raise capital. Investors and lenders look at your financial statements to make decisions. If your numbers don't accurately reflect reality, you're either leaving money on the table or getting turned down for funding you actually deserve. The two methods we're going to talk about today are FIFO and LIFO. First in, first out, and last in, first out. Simple concepts, but massive implications. FIFO assumes that you sell your oldest inventory first. Think of it like a grocery store. The milk that arrived on Monday gets sold before the milk that arrived on Friday. This is the most intuitive method because it mirrors how most businesses actually move product. Here's why FIFO matters. It matches your current selling prices with your oldest, usually lowest cost. When prices are rising, which they usually are, this makes your profit margins look bigger on paper. Your reported earnings go up. Now, that sounds great until you realize your higher reported earnings mean higher taxes. You're paying tax on inflated profits while your actual costs to replace that inventory have gone up. But here's the upside. FIFO gives you the most accurate picture of what your inventory is actually worth right now. Your balance sheet reflects current market values. This matters when you're trying to get a loan or you're trying to sell your business. Banks and buyers trust FIFO numbers because they're closer to reality. FIFO works if you're in industries where inventory actually does expire or becomes obsolete quickly. Food, fashion, technology, anywhere that old stock loses value, FIFO protects you from holding outdated inventory on your books. LIFO flips that script. You assume you're selling your newest inventory first. The product that just came in the door is the first product out. This doesn't match physical reality for most businesses, but here's why it exists. Tax strategy. When prices are rising, LIFO matches your current high selling prices with your recent high costs. This lowers your reported profit, which ultimately lowers your tax bill. You keep more cash in the business. It can save you serious money, but there's a catch. Most countries don't allow LIFO. If you're international or planning to expand internationally, LIFO creates complications. So please make sure to check your local area's legislation. The other major downside is that your balance sheet starts looking worse over time. Your inventory value on paper doesn't reflect current market prices, it reflects old, outdated costs. This makes your business look less valuable to investors and lenders. If your prices ever drop, you're stuck with old, expensive inventory on your books that you'll need to write down. That hits your profit hard all at once. LIFO makes sense if you're in the US dealing with consistent price increases and you prioritize cash flow over how your financials look to outsiders. It's more of a tax optimization play. Now, Before I show you how to choose between these two, I want to make sure you can actually apply this in your specific situation. I've put together a free interactive calculator that shows you exactly how much each method could cost or save you based on your actual numbers. You can plug your inventory costs, your volume, your margins, and it shows you a real dollar impact. Just head to the description below and grab the inventory method calculator. It takes 2 minutes to use and you could save you thousands of dollars or more this year. Go check it out, then come back and finish the video. So which method should you use? It depends on 3 factors. The first is where you operate. If you're outside the US, LIFO probably isn't even an option. FIFO becomes your default. If you're in the US and dealing with rising costs, LIFO could save you significant cash through tax deferrals. The second factor is your growth stage. If you're trying to raise capital or get acquired, FIFO makes your financials more attractive. Higher reported earnings, cleaner balance sheet, investors prefer it. If you're bootstrapped and prioritizing cash flow over growth metrics, LIFO keeps more money in your pocket. The third factor is your industry dynamics. If your products expire, become obsolete, or you lose value over time, FIFO protects you. You're naturally rotating old stock out and your accounting matches reality. If you're dealing with commodities or products that don't degrade and prices are climbing, LIFO is a pure tax play. So here's a real example. A retail business doing 5 million in revenue was using LIFO because their accountant set it up years ago. But they were trying to raise capital and investors kept questioning their financials. Their inventory values looked outdated and their margins seemed inconsistent. They switched to FIFO. Yes, their tax bill went up in 1 year, but their financial statements became crystal clear. They closed a funding round 6 months later because investors could actually understand their business model. The short-term tax cost was worth it for the long-term capital access. So here's the bottom line. There is no universally better method. FIFO and LIFO are just tools. The right tool depends on what you're trying to build. If you need clean financials for growth, fundraising, or exit, FIFO is probably your answer. If you're optimizing for cash flow and tax efficiency in a rising price environment, LIFO could save you tens of thousands annually. What most businesses get wrong is choosing a method randomly or just going with whatever their accountant suggests without understanding the implications. This is a strategic decision that compounds over time. My recommendation, use the calculator I mentioned. Run your actual numbers. Then have a conversation with your accountant about your 3-year business goals. Make the choice that aligns with where you're going, not just where you are today. Remember, you can't flip-flop between methods easily. The tax department requires consistency, so make the right decision intentionally. If you found this valuable, drop a comment below and let me know which method you're using and why. I read every comment and I'll personally respond with specific advice for your situation. Thanks for watching. I'll see you in the next one.